So, this week, chaps, we've got Greg May joining us on the podcast. Greg, I know you and I have known you probably more closely than I have, but for many, many years. Greg's been in finance since a young age. We'll find out exactly how young when I ask him. And he has been a very, very successful mortgage advisor for residential and buy-to-let mortgages. And in the last couple of years, he's gone on his own and started a business doing equity release, I should say, lifetime mortgages.
They are, in effect, interest-only mortgages, but the main difference is that with the lifetime mortgages, you don't have to make a monthly payment unless you want to.
What I quite like about it is he's effectively gone in to disrupt that market that's got a certain stigma. Not in the same way that we've done it with Avocado with loads of social media videos and pink hoodies, but he's gone in with a true care and attention to do ethically the right thing by clients, which I absolutely love. But not a lot of people know exactly what it is. So questions that you chaps are going to ask him alongside mine. Mike, what are you going to hit him with number one?
I think the question is why? Why would you take money out of your house and what's it going to cost you? So why do people do it? What motivates people to do it? And do people really, really call that number at the end of a Channel 5 advert?
We will find out. Tristan, questions?
I'd be interested to know the difference between a traditional mortgage and a lifetime mortgage in terms of term, costs, and why people should look at it, really, because it's something that I haven't really come across. And as we know, it's becoming more common now. So definitely know the true facts behind it.
Yeah, how recent weeks have impacted the rates for him as well. And, you know, what the difference is between the two will be interesting. So, yeah, Greg May is the business owner of Sage Equity Release. And we're going to find out all about it on this episode. Let's get him in. Greg, thank you very much for joining us on the podcast today. Looking forward to finding out a little bit more about exactly what Sage Equity Release is. But first of all, how are you?
Yeah, good, thank you. Yeah, very good, thank you.
Been an interesting few weeks?
Yeah, it's been, yes, let's use the word interesting. Yes, it has been.
Yeah, I mean, we're obviously property, you're in finance, and who knows what's around the corner. But I think probably topical and a nice way to lead into, let's just kind of give everyone that's listening exactly a brief understanding, layman's terms of exactly what products you offer and what clients it works for, I guess, really, as well.
Yeah. I offer lifetime mortgages and retirement interest-only mortgages. So it's double A to life lending.
Mm-hmm.
So people aged over 55, although with retirement interest-onlys, you can be 50, but most people 55. Ideally 60 years plus is the ideal age, but with more people coming to the end of their mortgage terms and not having repayment vehicles, then people are doing these at a younger age. But lifetime mortgages is what I specialise in, and they are in effect interest-only mortgages. But the main difference is that with the lifetime mortgages, you don't have to make a monthly payment unless you want to. Mm-hmm. So if you don't make a monthly payment, the interest rolls up and goes onto the loan. With retirement interest-only mortgages, though, you do have to make a contractual monthly payment. So they're more akin to your traditional mortgage. RIOs, as they're known as, retirement interest-only mortgages, they sit in between really a traditional mortgage and a lifetime mortgage.
Is that something that's been introduced recently? Because just generationally, we're now, I guess, accumulating more debt as we get older. And, you know, if we went back 40 years, people, you know, would have their mortgage, they would have their properties paid off easily, wouldn't they? But now it's a bit different. We're a bit more of a debt sort of generation, I would say.
Yeah, the RIOs have been introduced reasonably recently, probably about the last 3 or 4 years that the RIOs have been out for. And they were brought out to try and solve the issue with the interest-only loans that were coming to the end of the mortgage term. The lender was asking for funds or for the repayment of the debt. They didn't have a repayment vehicle, and they were either having to sell the home or find some other funds from somewhere. So RIOs were born to try and plug that gap, really. They are a bit niche, though, with regards to the criteria for them. So quite a lot of people don't qualify for RIOs. That I find that when I'm looking at clients' details, that a lot of them will fail the affordability model that RIOs have to go through, because, like I said, they are more like traditional mortgages. Whereas with a lifetime mortgage, you don't need an income, so it's not an income based product. It's more done on the the property. So the property is the risk to the lender with regards to lifetime mortgage. Whereas with the RIOs, it's more the individual, because they have to make a monthly payment on RIOs still.
Because we're seeing that probably quite a lot more in the residential sales market, aren't we? Where people are getting to the end of an interest-only term and they've still got money on the mortgage to pay.
Yeah, absolutely. Whether it's been because money's been so cheap for the last 14 odd years, people have just remortgaged to pull money out for whether it be family reason or whether it would be slightly sort of over living. I don't know if that's a phrase, but we all know what it means.
Yeah.
Living beyond your means, I think is what I mean. But we're seeing people who are, maybe property rich, but incredibly cash poor.
Mm-hmm.
And then when you get to 55, 60 years old, a traditional mortgage lender isn't gonna have a product for you. So where do people go? What are the choices for those people? Because most of our listeners probably aren't in that position, but maybe they have parents or relatives that will be hitting those numbers.
Yeah, I mean, the first thing to obviously consider is downsizing, because that is an option that has to be considered. It has to be on the table. You need to consider downsizing. Is it appropriate? Sell your property, repay the debt, and then if you've got enough equity, you can obviously then use it to purchase another home. So that always has to be considered as one of the options on the table is to just sell the property and downsize. But in my experience, a lot of people don't want to do that.
Mm-hmm.
I'm going out to see clients. I'm always having that discussion with regards to whether or not it's appropriate for them to downsize. But because they've either had the children grow up in the home, or they live in an area that they know everybody, they've got friends in the area. They know the house. They know they've done all sorts to it. They know there's not going to be any issues with it. But more that they just like the area, like their friends, like their family, and they like the home, and they just don't want to downsize. I do find when I actually cover it off with people. So if they don't want to downsize, then the other option is then to in effect refinance the debt. They're asking, Santander, Halifax, whoever they've done their traditional mortgage with, they're asking for the money, and they've got to find a way of paying it. So if they don't have funds in the background to pay for that, or borrowing from family or friends, which again is always discussed before looking at lifetime mortgage. Before taking out any debt, you need to really cover off all the options apart prior to taking out that debt. So you need to look at, is there any other cheaper way of borrowing, or do I have to do another mortgage? Because if you've got any other options and you don't have to do the mortgage, then don't do the mortgage. It will be, if there's other cheaper options, then do that, which is what I cover off when I'm sat with clients. I always see clients face to face when we're talking about this type of product. So sat down in the lounge with them and discuss what options they've got. An example, one year I was out seeing a client and they were going to do a lifetime mortgage, but towards the end of the conversation, we started talking about a bit more about family and digging a bit more just before we were deciding, or I was deciding whether or not it was appropriate. I just dug a bit more deeper on the family background, and it came out that actually there was a very rich individual in the family that could potentially lend them the money. So I suggested talking to this individual before I did anything on the lifetime mortgage, and in the end they actually did borrow the money from that individual, so they didn't need to do the lifetime mortgage. So everything needs to be explored before doing something like a lifetime mortgage, and then once all those doors have been closed, then we can look at doing the lifetime mortgage. But I'll help them look at all the options. That's the important thing.
It's a big commitment, I guess, because you're putting in reverse everything you've worked towards. So for a certain generation, paying off, we obviously always talk about borrowing more money to make money on this podcast rather than paying down debt. But obviously a generation above us, paying off the mortgage was probably priority number one for most people. And then you're effectively putting that mortgage into reverse. But we know 2023 is going to bring its challenges with cost of living, potential pension crisis, drop in stocks, drop in dividends from a lot of businesses. So that means pensions are going to pay less, or you're going to have to dig further into your pension to maintain an income. So people in this area are very, very property rich, but potentially more cash poor than they were this year or the year before. So is it something that maybe needs discussing more in an open environment about leveraging your 6, 7, 800,000 pounds value property that you can potentially struggling to heat?
Mm-hmm. Yeah. I think property needs to be brought more into the thought process with regards to providing an income and being part of your overall financial planning picture. Because again, a lot of people tend to discount the property, things like they're always looking at pensions and savings and so on, and they don't really look at the property as something that can do that. But it can be a vehicle to provide an income, and it's surprising the number of people that I go out and see that are sat in 700, 800, 900,000 pound houses, and actually you look at the income, and actually all they've got is perhaps the state pension and a small private pension coming in on a monthly basis, and yet they're having to pay quite a few bills with regards to a reasonably sized property. And again, this is where you go through the downsizing options again, because it may be sensible to downsize, because if the income isn't there to pay the bills, like the high council tax bills and the high fuel bills fuel bills, which is obviously very topical at the moment, then it might actually make complete sense to downsize. Even if perhaps they don't want to, it but might just make complete sense. So at that stage, you need to downsize.
I've got a 99-year-old grandmother in a 5-bedroom detached house. She's going nowhere.
Yeah.
Yeah.
Yeah, exactly.
Conversations can be reasonably short in
exactly.
those places.
I think it's very topical though, especially for people listening with parents. As my own circumstance, thinking about it, my nan unfortunately passed away this year. She was 94 years old. She'd been in the property for 50 years, something like that, and she needed a care for the last kind of 2 years of her life. But very independent lady, and had no intentions of leaving the property, had no intentions of downsizing. And, the thing that she did say to my dad is, I don't want to go into a care home. So the care was brought into her home to keep her in her home, because we actually felt as a family moving her out of her house would probably have been the end for her. It'd have been too much for her to handle. So in that circumstance, had there not been the ability to have that care financed, then this would be a great way that she would have been able to stay, for the remaining years of her life in her own home and kept her dignity, as she called it. This would have probably been the only option if it wasn't able to sort of have the family come together on that instance. I would have thought.
Yeah, no, definitely. And instances like that, you can release money in stages, in effect. For paying things like care, because when you're paying care on a monthly basis, you don't need all of the money up front, because you're not suddenly hit with a large lump of a bill.
No.
It tends to be a monthly or weekly payments that you have to make. So to save money on interest payments, you can draw money in stages to reduce the amount of interest that you actually pay, because you only get charged the interest on the amount of money that you draw. So something like care is ideal, perhaps to just release every 6 or 12 months some money to actually pay for the care bills as you go along. But something like that is ideal for somebody who wants to stay in their own property but does need help on a day-to-day basis, doesn't have perhaps an income to be able to pay for care, but has a property which has plenty of equity in it and can release the money to be able to make their lives a bit easier in the last few years.
Yeah,
does that potentially work in a time where interest rates are temporarily, we hope, high?
That I think that's important to at the moment with the clients that I'm seeing. If they don't, I'm encouraging them to release a lower amount of money at the moment because the rates are high. So unless there's a really good reason to release a large amount of money at the moment, I am encouraging people to release a lower amount whilst the rates are where they are. So
if we say, look, we need £150,000, but only over the stage of 10 years, you can say, well, okay, rates are high now, so take the first 10 this year, and then next year take 10, and then next year take 10, and then if rates drop to 2.5, take the lot.
Well, potentially. I'm not quite sure of the lot, but but you got that's a fair point in that you want to be taking as little amount as you can now whilst the rates are high. Hopefully, the rates are coming down the other side. And
that compares with drawing from a pension.
Yep.
When if the value of your pension's dropping, you want to draw as little out of your pension as possible when it's dropping, because you're getting penalised twice effectively.
Yeah, no, absolutely. Yeah, absolutely correct.
So based upon what Mike said then, so in the stages, so each case is reassessed at the time of them wanting to borrow more money, or is it set in stages where they're guaranteed that income?
You set the lifetime mortgage up to start with, so you do all the legal work, because with lifetime mortgages it's a remortgage, so you have to do all the normal conveyancing work. The property has a first legal charge on it, which is important to understand that your property does have a charge on it. So they are mortgages. So in theory, the lender can ask for the property to be sold and have the loan repaid. But with a lifetime mortgage, it's generally only if you breach the terms and conditions of it, which need to be explained to clients. Whereas with a traditional mortgage, it's more if you don't pay your monthly payment, then your home is at risk. With these, it's more if you breach the terms and conditions of them. So it's important to understand that it is a mortgage and there is a first legal charge in it. So all the legal work is done up front, and a reserve is put onto the account in effect. So they do an initial lump sum of say 10,000 or 20,000 initially, but then say 100,000 reserve that they can draw on in future.
Okay.
The only issue with that is that the reserve isn't guaranteed though, so it can be withdrawn. So that's the only thing to be aware of. It's not set in stone. It's unlikely to be withdrawn, but it can be.
Okay.
And so you just need to understand that. So then when you take further funds, it's either at the prevailing rate at the time with regards to the lender's new business rates, or it's at a set. Some lenders do it at a set reserve rate. In effect, they have a specific rate for reserve when people draw on the reserves. Other lenders will do it at new business rates. So again, it's important picking the right lender to make sure it's the right one to use. Yeah.
So how does it compare with a traditional mortgage in terms of a rate? So at the moment we're looking 6, 7, 8% in some cases. Are we seeing a big difference in that? And how long is the term for? Does it remain the same for the duration of them vacating the property, or does it go up annually, or how does it work?
The rate's fixed for life, or 99% of the rates on offer are fixed for life. There is a variable rate on the market, but 99% of them are fixed for life. So once you have that rate on that particular tranche that you've taken, that won't ever change. Interest rates on them vary. At the moment, the lowest rate on the market is about 6.7, 6.8, but they can go over 9%. They're being quoted at the moment. So the rates at the moment probably starting with a 7, something like that.
Still competitive in terms of what's been going and
still
what
competitive compared to what's on the traditional mortgage market. Not dissimilar at the moment, which is unusual because generally speaking, these lifetime mortgages will be about 1 to 1.5% higher than your normal traditional mortgage rates. That's a good rule of thumb to use. But at the minute, they're not too different to that market. Certainly, the 2-year rates I've been seeing anyway.
Still a lot cheaper than I was expecting to hear anyway. And those that maybe took it 12 months ago when interest rates were low, I guess laughing now if they've got that for lifetime.
Absolutely, yeah. I mean, start of the year we were talking rates under 3%, which fixed for life. So if you did it at the start of this year, it was a good time to do it. Well, in theory, as long as it was appropriate, obviously.
A lot of people seem to have been purchasing holiday homes and even turning them into holiday lets as well. It seems to have been very, very common since lockdown in the UK specifically. And you can get, down Hayling Island and things like that, nice locations. You can get holiday homes that pretty much cash buy. I know you can get the finances through different places, but pretty much cash buy is the typical way to go. Is that the sort of thing that you've seen a fair few of your clients sort of utilise this finance for? They've maybe taken it for holiday purchasing and stuff like that?
Not a great deal, actually.
No.
Not a great deal to actually purchase holiday homes. I've done it for purchasing caravans, motorhomes. That there was a bit of a spate of that going on a little while back, but not actual holiday homes themselves. So no, there was a product on a lifetime mortgage where you could do it on a holiday home. It's not available now. The lenders exited the market temporarily. So it has to be in the main residence now, but not actually for holiday homes. So it tends to be main residences.
I just wondered if you get the right place and you end up being in there for a couple of months of the year, that you can Airbnb it and actually sort of making some income potentially on the finance that you've raised.
With the lifetime mortgage, that's one thing that the clients need to be aware of, is that if you took out a lifetime mortgage on your property and then wanted to let it out the lender, then I'm 99.9% sure the lender would say no, you're not allowed to.
Is that let out your own property?
Let out your own property.
But if you were buying a caravan,
if you're buying a caravan for cash and using the equity in your,
Yeah.
and then that's, you can do what you like with that
Do
at
what
that
you want
point,
with it,
because the loan's on the main residence.
just wondered if you could balance out some of the interest payments through doing a couple of months on an Airbnb.
Yeah, we have potential. Oh, yeah, sorry, I'm with you. So
Yeah,
to actually
yeah.
then cover off the interest on the main resi. Yeah, potentially. Yeah, potentially you could do that, as long as you could release enough to actually buy it in effect, because of the loan to values on lifetime mortgages are lower than the traditional mortgage market. So you're generally talking sort of 10 to 40% really at the moment. You could get 50% plus at one stage, but really to get the, I was going to say reasonable rates. Well, I suppose that's a bit of
Sort
a
of the grand
tongue in cheek sort of
Yeah.
remark at the moment. But sort of 10 to 40% really is the maximum loan to values. So you'd have to have quite a nice sized property to be able to release sufficient to buy a holiday home. But yeah, in theory, yeah.
And I can tell from the conversation that you tread ethically is really important for you, because of the type of sensitive, sort of conversations you're having with people, which is lovely to hear. What's the Greg May kind of background? What's the story? How did you get into finance, and how did you sort of come into this type of product and these type of clients that you work with?
It's my background is financial services all my career. So I started off in a bank when I was 16, making the coffee for the manager in those days, as we still did in those years. And then I just became a mortgage. I say just, it wasn't just, because it was a tricky and hard job. But I was a broker in an estate agency, and a couple of estate agencies. I was arranging traditional mortgages, and most of my career was spent in the traditional mortgage market. Ran a mortgage brokerage, managing a number of brokers for quite a long time. Then I was able to exit and start my own company, and I knew that I didn't really want to be talking about traditional mortgage market, the traditional mortgages, only because I'd done them for so long.
Yeah.
And so the later life market was something that really interested me in looking after people in the older generation, to make sure that they get good advice and make sure that they're looked after in the right way, and that they're doing it, then it's the right thing to be doing. So that gave me the opportunity to start my own company and specialize in lifetime mortgages. I think it's important to specialize in it rather than trying to do lots of different things. Just specialize and be good at what you do.
Yeah, I think the care and attention that you talk about in the people that you deal with, and then also being a specialist, and it means you can genuinely give the right advice as well, which is really important.
Yeah.
So your background in finance, and didn't even do the kind of the Tesco's bagging of shopping or anything. You're straight into the bank at 16.
I did my stint working at the back of restaurant kitchens, washing pots when I was sort of 14 to 15.
Fair enough.
I've got my hands dirty at
You
one
did
point.
a little bit of that, yeah. But what's, with everything going on at the moment, what's your expectations for banks? And sorry to put you on the spot with that, but it's always interesting to know, because you've got such a vast background of experience in finance. What's kind of your 2023 outlook on things?
Oh, blimey. Yeah, it's I think it's going to be an interesting ride for the next 12 or 18 months, interest rates wise. I don't think we've hit the peak yet. So I think it will continue. The rates will continue to rise, unfortunately.
Are you expecting another base rate climb?
Yeah.
It seems to be the rumour, doesn't it, at the moment? It's just a case of how much rather than when.
Absolutely. And probably again, is my gut feel. Until things start to turn a corner, I think that's really the only tool that can be used to try and combat the challenges that everybody's got. So I think rates will start to rise, but we do adapt well. We do adapt well as generally as a country. I think in general, we ride through these things and we just get on with it. And I think that's what we have to do at the moment. Just get on with it.
Yeah.
We can't influence anything with regards to interest rates or anything. So it's going to be what it is. So I think get on with it and just plow on and do the best that we can, and continue to give good advice, help people, because it is going to be tough for a lot of people. And I think for the next 12 or 18 months, it's going to be hard. But hopefully at that stage, as long as everybody's sensible and the banks will keep lending. So I know all these silly headlines that were around a few weeks ago, which were silly headlines with regards to rates, mortgages sort of, not being available. And I think somebody on Question Time at one point was saying that their rate went to 10.4% or something, which it just, no, That wasn't happening.
She must have been a pretty bad case.
Well, just or
pretty
just,
unattractive case for a bank.
or just wanted to get on Question Time and get on TV,
that.
probably.
Yeah, fair enough.
Yeah. So I think the banks have started to find their level with regards to what the rates that they need to lend at. In my lifetime mortgage market, there's a couple of lenders that have exited the market. They have exited because they are trying to work out how to price. So it's about working out the pricing of the product rather than not having the products there to offer. So it's not like in 2007, 2008, which we all went through, where there was liquidity issues. It's not
climate.
that. It's not that at all. It's just a question of how do we price it.
Yeah. Okay. No, good outlook.
So, Greg, the reputation of lifetime mortgages, and particularly, I guess, the phrase equity release with me, in the past has sort of sat around slightly strange adverts on Channel 5 of really happy dancey people and then pensioners on cruises living a good lifestyle, and then the sort of tagline at the end, your home may be repossessed if you don't do this, that and the other. Where one of our pillars of our business is to be so good you'd recommend us to your mum, which means a lot to us because you wouldn't ever recommend anyone goes to your mum's house to recommend doing something unless you absolutely trusted them. Where has equity release come from and come to, and what would be your recommendations to people to potentially look out for if they were actually looking to go down this path?
I think it's come from an area that has had and does still have, unfortunately, a really bad reputation. And in the years gone by, probably justified, in fairness. However, now we're in a time where the product is fully regulated and it's policed a lot better by everybody involved. The Equity Release Council have put in some really good rules to protect consumers, to make sure that they're getting the right advice. And the main thing is to make sure that you're going to an independent broker like myself.
Got to put the plug in.
Yeah, exactly. But to make sure that you're getting good independent advice from somebody that can look at all of the providers on the marketplace. But there is still a stigma to it. Particularly with, as you say, with the word equity release. Some people are actually trying to get away from the equity release word and just use lifetime mortgages. I just tend to keep calling it equity release and then flick into lifetime mortgages as well. So I sort of use both terms because I'm quite relaxed about it, to be honest, because when I see people, I know I'm going to look after them and I know I'm not going to give them something that's not appropriate for them. So I think it's really important to understand that with this type of product, it's so bespoke to the individual that you're dealing with that it might be perfect for one individual but completely wrong for another individual. So you do tend to see a bit of social media commentary which use a blanket, don't touch it with a barge pole, I've seen, and all this sort of stuff, and to put that kind of comment on there is unhelpful because it's such a personal thing. So it might be the correct advice for client A to say don't touch it with a barge pole, and if that is correct, I
couldn't agree more, because as we said earlier in the chat, if you're sat in a £800,000-900,000 house and you can't afford to put the heating on because you've got no cash flow, all of your money is in that property, and frankly you must either downsize or leverage that asset. And for someone to cut you off with no conversation and generally no education on the subject is worse than the reputation that precedes it, I suppose, in that sense. And it's interesting that we were speaking off camera, and a lot of people are using it not just because they're in financial trouble, but potentially for inheritance tax planning.
Yeah. Inheritance tax planning is it has been quite done quite frequently when rates were lower. It's a challenge now, obviously, that now rates are higher. There's an argument to say that it's difficult to do that at this stage. But it can be used for inheritance tax planning. It can be effective as that, but you must get advice from from a qualified wealth advisor before even thinking about doing something like that. It needs to have proper advice, because if you just decide, yes, I'm going to take money out from an inheritance tax point of view, and then don't use the money in the appropriate way, it just could be completely wrong. So you really do need, that's an area that absolutely needs very, very good advice on before using it for IHT.
Different podcast for that one. Different podcast for that one. And don't be put off by the social media element of things. You should see some of the things that people say about me on TikTok. It's quite an interesting. We're estate agents, obviously, so when you've got large eyebrows and you're going on video, they can be quite aggressive, but I smile at it. Tristan, let's take it off subject a little bit. Let's, Greg mentioned that he's worked in agencies, worked in property, worked in finance. So let's fire your 3 questions at him, and let's get some information and education here.
No pressure. So if you invest in the perfect buy-to-let deal tomorrow, what does that look like to you?
The perfect buy-to-let deal?
Yes.
But perfect buy-to-let. So nothing to do with what you do now, caps off, but just, it's an investment that you're interested in. What would you go for?
Freehold.
Okay.
Only because I've never been a great fan of leasehold.
Fair enough. Yeah.
Just a personal preference. And I think holiday lets, are a good starting point. So I think if you're going on holiday down in these places and you're purchasing or you're hiring a cottage in these areas, is it something perhaps that you could buy yourself and let out in the sort of holiday let areas? I think they're pretty good at the moment. Other than that, perhaps uni areas and places like that would be pretty good as well. It's not my area. I would never pretend to say that it's my area of expertise, that particular one, but that would spring to mind for me. Holiday lets is a big one because there can be some very nice returns on that.
So is there a specific destination you'll choose if you did have a holiday home?
No, I mean, to be honest, it depends on the prices now, because prices have gone up so much down in the southwest and these areas over the last few years that if you'd have asked me that 5 or 6 years ago, it would have been the southwest, but prices have gone up there considerably over the last few months. So I think it's just picking the right area now, which is very difficult because they have gone up quite a bit, the holiday let areas.
Yeah, short wins, great equity growth. So if you know it's going to grow, it's worthwhile looking at.
It's been a common answer actually when we've asked that question to a lot of our guests is the holiday let world, because it's been popular, hasn't it? I think lockdown has meant that just COVID in general has meant actually, getting on a plane is not as easy as it once was, but you can just jump in your car. 2 hours later, you're on holiday, and the sun's shining. It's a little bit chilly, but we're in the middle of October and the weather's all right, isn't it? At the moment. So next question, Tristan. Fire.
And what's the single best piece of advice you can give our listeners out there that are looking to invest in property for the first time?
Take advice. Speak to some peers. So perhaps go on maybe some forums or some property webinars to learn about the subject. Take advice from a broker to talk about the finance, so you know the ins and outs of the finance, and don't commit more than you can afford.
Good advice. Like that. Yeah. Really appreciate you coming on the podcast, talking about a subject, like you say, which has got sometimes a certain stigma about it, but actually having you on today, it's helped me personally truly understand it. I'm sure for you guys as well, and hopefully the listeners. So it's been a real pleasure kind of getting to know all about lifetime mortgages, equity release, whatever you want to phrase it as. But I definitely think if people are listening or watching, they want to get in contact with Greg, be it about them or their parents or any particular subject for more advice, then ethically, I would definitely recommend Greg is the best place to go to. So feel free to DM us or contact us if you want Greg's details, and obviously we can set you up with a telephone call and then a face-to-face visit as you like to do.
Absolutely. Yeah.
Thank you so much, Greg. Appreciate it.
Not a problem.
Okay, knowledge bombs just hit the table after that episode with Greg May. I thought I knew a little bit about it before. Turns out now I know a lot more thanks to Greg's education across the table. And it was just knowledge bombs, wasn't it? And it was actually interesting to see things. We always talk about perspective and how it's anyone's reality. And now having a different perspective on this, I probably know there are clients over the years coming that we can give some advice and pass them to Greg for the right reasons, really.
Yeah, like you say, it's very much something that people have to consider, think about, discuss before they go into. But to have an ally like Greg, who is quite happy to give you the right advice and walk away from doing business, has to be something that is a benefit to you and your family.
Absolutely. Tristan, I know you asked a couple of questions on rates and then a little bit on the market. He did say that obviously the buy-to-let investing world is not his background, but he spoke about holiday lets, and I think he actually gave a really good overview of what he thinks is going to happen next year. But your takeaway, what did you think?
I thought it was interesting to know that the rates are not too dissimilar from a traditional mortgage. Only by a couple of percent, by 1.5% roughly.
Yeah.
But also the fact that he's seeing more people take money out that's basically putting it on things like buying a caravan or something where they can enjoy really and just take advantage of that money. But it's different to what you'd use your money for. Well, obviously cost of living, bills going up and whatnot at the moment, which a lot of people would need that money, but people are spending in different areas. So it's interesting to hear that and the rates.
Yeah, very, very specific to the individual, to the family, I guess, in reality as well. You teased and touched on some inheritance tax planning around it as well. So maybe that's an episode we can look into if that's something you want to listen and find out more about, and you know someone, then feel free to plug us and we'll get them on the episode. But until the next week, next Friday, we've got another cracker coming. Thanks for everyone that's downloaded and listened, and don't forget to subscribe. I'm flicking through YouTube and through Spotify. I don't think there's a podcast or a video channel on YouTube that landlords can land on where they're not being sold something.
I mean, it'd be the first time any estate agents ever asked that question, but why not ask that question to a wider audience?
Estate agents have the knowledge there, but they don't seem to share it.
You can do different episodes based around someone that wants an exit plan or someone that's just starting their portfolio.
The rules change every year.
Yeah.
But why not just open the floor out and just say, well, is property even the best investment out there?
And tax advice is a big thing, especially with everything that's changed, capital gains tax, and obviously your stamp duty costs that you need to pay and whatnot. People don't realise what they need to prepare for.
We build a podcast and we build a YouTube channel, somewhere that landlords can go and they feel they're not being sold to, but they're just getting quality advice.